So let's jump right into this. I want to talk to you about the state of insurance tech. This is the presentation I recently gave at the OnRamp Insurance Conference. And we'll start off with the fact that there is no such thing as user engagement in insurance. This is neither good or bad. It's one of those accept that which you cannot change. And so with that in mind, let's look at the 22 insurance brands that are part of the S&P 500 and further delve into those that are outperforming their peers. And by outperforming, think anybody with a stock return of over 22%. So what these winning brands have in common is that they are in part investment companies. In fact, Assurant shareholders saw the same value as Facebook shareholders. So while Assurant is busy deciding how to best allocate its $210 million fund dedicated to strategic acquisitions, Facebook, vice versa, is busy combating fake news, cloning Snapchat, and deciding how to best deploy virtual reality technology. And so you get the point. All of this to say is that there is a really big gap between shareholder value and customer value in insurance. And so here we are with tons of funding, and by tons of funding, think 1.6 billion, over 65 rounds of insurtech related investments in 2017. And that's definitely one interesting observation. But a more interesting observation is that almost 70% of these funds are allocated to companies that currently or can potentially have a revenue stream outside of insurance. Perfect example is SoFi and WorkFusion. This allows you to put the whole concept of insurtech funding into the right perspective. And so here at Coverage Air, we track some 1,300 brands, and we wanted to look at popular tech that is driving innovation. And keyword here is popular, and the result was e-commerce, mobile, software as a service, and data and analytics. In other words, our two key takeaways here. One is that back-end innovation is taking the back seat. It's first and foremost about getting closer to the customer. And second, if I had to translate these technologies, it really would be to convenience, efficiency, and opportunity. So let's spend a bit about that opportunity called data and analytics, because if your data sets are making sense to you right now, I would argue that you're doing it wrong, because now is the time to experiment with new data sets in an attempt to get to a better product market fit in the future. And so historically, insurance has always been about selling insurance in 100 different ways, as evident by these brands, both old and new. And what e-commerce is allowing insurers to do is target their audience more effectively using technology. And so we are seeing established insurance companies launch direct-to-consumer brands in addition to their current acquisition channels. You can expect this trend to continue, but you will see a bigger conflict of interest arise. Now, in terms of aggregators are continuing to pick up interest, even aggregators in the auto line of business, which for the most part is a commodity product. And that is to say that the premise of selling with that apples-to-apples comparison is very much relevant to the average insurance shopper. So speaking of commodity, I'm thinking of kind of scarcity and the opportunity to overturn commodity on its head. So here's what scarcity looks like in the luxury world, right? It looks like the Hermes Birkin bag. Here's what scarcity looks like in insurance. So this is the Next Insurance workflow, and very quickly, a quick refresher. Next Insurance launched last year as a digital broker targeting small business insurance shoppers online. It partnered with Liberty Mutual, Hiscox, and Markel. It has about 38 million in funding. So a well-funded startup. And here's its workflow. If you're a personal trainer and you visit the site and you answer yes to do you own or operate a gym, you will be faced with a declination message. By no means a great user experience. But this is the realization that in insurance, the opportunity is in the details, and the details are part of that appetite and underwriting criteria, which should be baked into the digital process and shouldn't be an afterthought. So moving forward, a little bit of history. The former CEO of Auto Owners wrote this book, Take the Stairs, where he explains the two-step process of purchasing insurance. One, you find the right agent. Two, you then find the right coverage. So that kind of linear thinking has no room in kind of a mobile world that we live in. And it's really interesting to see how mobile strategies are way beyond just having a mobile app, and how micro-insurance players are both targeting third world countries as well as millennials and the privileged. There's definitely one mobile startup to watch, and that is SureBuddy. SureBuddy launched earlier this year in Uganda, and it basically offers free insurance coverage for warranty or for funeral insurance in exchange for users watching advertisements on its app. It will be fun to see how this one pans out. Now, there's a lot of overlap between mobile apps and telematics players, and I do think this is the beginning of the end of telematics. Telematics is great for fleet, maybe great for niche segments, but at the end of the day, it's a really super expensive strategy that will be swapped by safer cars. And so when Root Insurance says, hey, we have this new discount for Tesla drivers, what they really are saying is that we want the younger rich and those that drive Tesla. And so what you should be thinking is, hey, can I get that audience in a cheaper fashion? Now, speaking of Tesla, I think it has no choice but to enter the insurance business in US simply because current players are not offering a great product to begin with. In Hong Kong and Australia, obviously, Tesla collaborated with QBE and AXA. So thinking of Tesla and going from one brand to the other, I don't think there is the Uber of insurance, but I will say that it's really interesting to watch how leading insurers went from saying no to ride-sharing coverage a little bit over 2 years ago to actually supporting this coverage in majority of states, leading it with Geico, but quickly followed by other leading and established insurance players. Speaking of leading insurance players, there's this association to tie them with that kind of winning over price, but if you scratch below the surface, they do offer some really interesting and easy to use workflows that explain, about the product coverage. Farmers recently launched Berkey's, which is a really creative campaign around your far-fetched claims, basically saying, hey, we will be there when it counts. So don't think that transparency is kind of the play of only new entrants. Insurance companies get that. Now let's talk about losers and winners. And when I say losers, I basically mean this should not be your go-to market strategy. And we'll start off with on-demand. Let me define on-demand with the notion of you're buying insurance right now with today's effective date. And here's a great company, Verifly, which offers on-demand drone insurance. And according to their Facebook page, they are busy working on a feature to allow drone operators to schedule coverage in advance. So it begs the question, if you're buying insurance right now at the moment, at the spur of the moment, then the question is why? I'm also not a big fan of peer-to-peer. I think it's a cute strategy. I prefer group buying because it speaks to that element of scarcity. But I do think that peer-to-peer is kind of a complicated way of saying, if you buy with your friends, you may get a discount at the end. So Lemonade is a perfect example of someone that picked up that term and later dropped it. And speaking of Lemonade, it's also a great example of it's good to be bad, and they are still picking up momentum from within and outside the insurance community. Off on a tangent, InsurTech Journal, if you Google it, you will see that it is not owned by Insurance Journal, which is quite a surprise. You would think that a media company would have the foresight to have secured that domain. But speaking of Insurance Journal and thinking of insurance expertise, if insurance expertise was such a winner, we would not have seen that many new entrants enter the space. And judging by the amount of traffic that Insurance Journal attracts to their website, out of some at least 2 million insurance professionals working in our workforce, I would say that if the notion of leaders are readers is true, then the industry has a big problem. Last but not least, I don't think sex sells, and if you didn't get the memo, it's all about personality now and not just about the pretty face, and this is not just within insurance. This is to say that I do believe some new entrants will have the opportunity to gain market share if they leverage their voice. They tend to be more personal than the traditional big corporate brands that we see out there. So if I had to pick one brand, I would pick AXA, obviously because they're a global insurance brand. And if I had to extrapolate what they were doing is that they are doing it all. So they're reorganizing their structure. They're investing in new skill set within their current workforce. They're experimenting with new technologies. They're building this new ecosystem to attract InsurTech startups, and obviously finding these really creative ways of attracting new talent to their workforce. So the winner does all is definitely something to take on in terms of what you can do. Now to the question, so what about Amazon? Well, Amazon is no longer just in the retail business, right? They are in cloud computing, they're in grocery delivery, obviously they're in the filming now. And I find it really hard to believe that Jeff Bezos will swap the red carpet for an insurance conference anytime soon. That being said, Amazon does offer the Amazon Protect brand, which is a warranty insurance product in Spain and Italy in collaboration with the Warranty Group. But by no means is that disruptive, and it's kind of a small role within the context of the insurance industry. But this is to say that you should operate under the premise that if someone has an audience, he is able to enter the insurance industry. I do think barriers to entry are really, really low. And now we have a tendency at Coverager to end all our newsletters with a tweet, and so I will do the same here, and thank you for your time.